Hello and welcome to another video. In this video, I will cover the Coca-Cola company, the Coke, the brand which we have lived with almost, and since our life, at least I'm not sure about you guys, but I have drink a lot of Cokes, at least since my childhood. But when I got aware that it has more sugary and all the drinks, and I stayed away. But still, uh, I drink it. But here we are not focusing on the drinking of the company, but here we are focusing on is the Coke is still good for our the long-term investment perspective for our portfolio. And this is one of the key company in the Warren Buffett portfolio. If I'm not mistaken, it's around 6 point some percent in his portfolio still exists, and most of the time you can saw him he's carrying a can of Coke, right? But given aside, right, so that's his. But do you think it's still valuable? At the moment, this is a very global brand, and this stock is a little bit beaten still, and it's haven't reached up to his pre-COVID price yet, which I will show. But given all things set aside, I will go to the fundamental and financials of the company. Also want to see if this is just a sugary company of the can of Coke, or have they diversify, right? That's one. And if I and then I run also in my models to see what is the my intrinsic value of it. Is it still making a sense, or is market is overvalue before it was the pricing? So that's also I consider. And yeah, so that's pretty. And then I'll try to form some opinion on the company as usual. So if so that's how usually I started. Okay, so let's get started. So as I mentioned, I'll cover all those agendas: enterprise value, the cash flow statements, and financial and the buyback. And here I also go to the financing statements, just to give some idea. Okay, so let's continue before any delay. Okay, so the Coke, as you can see, this is the from the Yahoo Finance, the plot, the price chart. It was trading around 60 something, right? But even until now, it recovered as a V shape, but you see it drops from 50 to come back to 45. So it still have a lot of room, almost like 25% to go back, right? So that's what, and is a global brand. So this is the beaten by the current environment. So we like to capture, do you think it's a good investment from the financial perspective? Okay, so that's what we'll try to cover today. Okay, so before I'll go further, let me introduce myself just for the audience who are new to my channel and click this video. So I'm Pramod Kumar. As you can see, I'm a CFA charter holder and FRM certified, and this is my website riseanalytics.ca. And in my website, in my channel, I usually does the stock review from the long-term perspective. Go to the financial and see is just the global brand, or is the new IPO, or is it good suitable for the long-term investment perspective, or is just hype, right? So based on that, I'll try to put my own opinion on it. So that's what it's all about. And also from time to time, I also try to educate the audience to put some video, and also take the questions or the tickers from them if they want me to cover on my channel. So, and put in my list and use and try to cover that as well. So I have like a broad, pretty much more technical, and also stocks, the IPOs are also there. The carnivals and cruises also got requested. REITs are also requested. So I did a couple of those as well. So yeah, so check it out, and if you like it, give a thumbs up. Either you are new or the existing YouTuber, right, or the community. Okay, let's get started. So so this is the brand, right? So one thing, this is, I like this slide, this gives a lot of information in one. So they claim as the Coke is their brand. This is their soft drink sparkling sections. They have this Coke and Fanta and Sprite and all, but they also got into the juice and the plant-based dairy-based drink. So Simply Light Juice and all, right? So we know these brands, the Smart Waters, is also there, so they are into the water and hydration as well. Coffee and teas, which is there as well, right? So, and then Coke coffee, okay, I never drink that one. Okay, Costa coffee, okay, I was not sure is part of the Coke. Okay, and then this energy drink as well, so they are in energy drink. So far they have 50% of their the non-drink, the revenue is coming from non-drink, right? But major of their the brand is from the 50% is still the value, retail value is from the Coke, right? So they're still half. Okay, so that's pretty good. And also one thing I think I have put it here. Yeah, so their major brand is Simply Light, Coke. They have transformed their portfolio. They have heavily mentioned that, and Honest, right, which is this more like an organic kind of a drink. I have never tried this one, honestly. At least I haven't seen this in Canada. So maybe it's more on the US side. Okay, so let's go next. Yeah, one thing to note here is they are also not only diversifying, but I also like it that they reduce the level of sugar, right? So look at here how much sugar usually they have put in. Our new Coca-Cola trademark recipe with 30% less sugar begin in Mexico in 2018, just 2 years from now, right? Before and then roll into it, and they roll into the 25 international market, and the new formula has 280,000 tons of added sugar, right? They have removed that much, a lot of sugar there. Wow, so that much sugar is being removed. That's crazy. Okay, and then they have more fat there, so they're trying to make it less sugar, but they cannot just eliminate immediately, but that's their main brand. Okay, so that's pretty much on the high level. So let's go to the financials. Okay, from the financial side, I'll start with the margins. So from the gross margin looks quite good. It's around the 60s range, right? It's not bad. It was a little bit better in 2017 and 18, but it then dropped again to 60 side. On the operating margin or EBITDA margin, it's pretty 30, and then they have improved in 18 and dropped it. Similarly, on the net profit margin, it's dropped, and then it get dropped a lot actually in 17, and then it get improved. So overall looks okay from the margin side. Let's go one step further. Okay, from the net revenue side and net income sides, we can see these are in millions. So these are the revenues. So revenue is keep declining if you see this, right? Because this is a 5-year I picked it. So from 2015 to 2019, the revenue is decline. The net income is decline as well, right? But here the net incomes jump in 2018 and 19, which is a good sign. So what the company does, so let's see, right, what the company really does in 2019 to make the revenue up all, and also the revenues increase, but that's good sign from as compared to 2018, if I'll see here, and actually 2017 as well, right? The coming back to the track. So there is some volatility in terms of the revenue and the net income, right? So that's for sure. Okay, now this gives a much of the, if this is the year variance of the revenue growth, and we have seen the revenues decline and then it start going up, but it doesn't go that much up, right? It's -5% and then 9% up in terms of the revenue. So I don't like this graph. It's more like a V-shape graph. So they're not consistent in terms of the revenue, which is a little bit surprised. Similarly, on the EPS side, of course, if the revenue is shaky, the earning per share, and this earning per share is basically it's dropped a lot in 2017, and even if it gained a little bit in 18, it's a huge jump from minus to positive, and then it's coming to 38, a little bit in line, right? Okay, this is their dividend. So this is a dividend paying company. So when I have used the model to come up with the price to my price, I used the couple of frameworks. One of the framework I used the dividend discount model as well, in addition to free cash flow model. Okay, so which I will tell the price later this time. This is a little bit extra, I did it. But on the dividend discount model, what it's trying to show is, okay, if this is the dividend, right, and this is the per share dividends from $1 to $6. So notice here, right? So this is the dividend is growing gradually, which is good, right, from $1 to $2. But this doesn't give us the complete picture. But why? Because look this way, right? In 2017, they paid more than of their earning, right? So that's not a good sign. So the company goes beyond, maybe they take a debt or something, right? And then they have paid it, but that's a one time off. Maybe that's a problem in the company in 2017, but overall the ratio is okay, is down. Okay, so before I go to the share buyback plan, I want to go a little bit deep into the financial to show the Pratt model and the liquidity side, right? So let me open my spreadsheet. Okay, so this is I take the little bit more data, annual data on the from 2011 to 2019 to see more what's going on. So you see from 2011 is 33% in terms of the revenue growth, and we have seen this is not rounding, so 8.65 at in 2009, but it was a huge drop in 2017 in terms of the revenue. So that's why you see the revenue drop there. In the cost of generating those revenue, it's quite increased substantially from 18 to 19. So that's another bad sign. So that's why I have highlighted in red, because you see the revenue is increased by only 8%, but in order to increase the revenue by 8%, the company has to spend 12%, and that's a very well stable company, so which is not a good sign. Okay, so this is also showing earning per share, but now I want to know from where the net profit or the earning is increasing, right? So that's the net profit margin, because the net profit margin was 18 and it's dropped to 15 and way dropped in 2017. We can just maybe ignore that, but usually it goes around 18%, right? And then it suddenly jumps to 2019 to almost 24%, right? So that's why we have seen 38% jump in the EPS, right, from 2018. But why this jumps, right? So I find this jump is because of couple of reasons. So the first reason is they paid less tax, right? Usually the tax is only 16%, so that's contribute. So think from the 2018 is 21%. Okay, so that's and usually their tax bracket is around 24, 23 and 19, right? So maybe they are paying less taxes here, and suddenly they have to pay a huge tax in 2017. So that's why they cannot defer the tax anymore. So that's why it's a huge drop in terms of their earning and all. So that explains at least this section, right? But in the next year they continue back to 21%, and seems like again they are doing some tax deferred here or something, right? I cannot say, but it's assumed, like based on this data, right? They paid less. Is not less, but is the tax ratio is less. The another thing is which contribute at least to my profit is they're taking more debt. So if they're taking more debt, look at the financial leverage is 4.09. So that's huge. So those are the two things. And for sure, their EBITDA margin is worst as compared to the 2018, right? But it's better if I compare with all other previous years, which is very good, because previous year is their operating margin is only 26, or so their operating margin is quite increasing, but at the same time they are taking more debts. So let's say if they're taking more debts, what happened to their liquidity, right? So the liquidity, I'm not very much honestly impressed by the liquidity, but maybe because the beverage industry is like that. So it's even the current ratio is less than 1, right? So this means the company must be having the hard time from the liquidity if they don't have enough financial free cash flow, right? But from the free cash flow they are okay, but the short term asset compared to the the liabilities is even less, right? So, and if you want to know more on this one, I have a separate videos describing this on my channel. So how to compute and using the current ratio, what it is, and cash and quick ratios, and even the gross profit margin and all. So feel free to check it out. Okay, so so that's not very great. So let's continue our journey. Okay, so the financial looks okay, but it's not that outstanding. I say it's like average or maybe closer to below average. Uh, okay, let's put it average for now, and let's see if it's how it goes. Okay, so the share buyback is a very good sign. So the company is doing the buyback of a share, and so in 2012, so this is from I took from the annual statement of 19. So what they mentioned, since 2012 it's approved 500 million share, right? And in 2009 they have a new plan of to purchase. So this is a good sign. This means the company will be doing the share repurchase, right? And they have did in the past. So number of share repurchase happen in millions, right? So 82 million in 2017. Okay, so the company maybe is avoiding, okay, I don't want to put some word here, but doing the share repurchase and giving the money back, right? And okay, so the average price what they did is 48, 45, 44, and currently the price is almost around 45. Okay, so they did this share repurchase and they haven't finished it, because if it's in 2019, you can see they have 150 and they only have spent 21 million purchase it. And this means they have a lot of rooms to go. So at least if the nobody else do the buyback, so from that perspective I think it's that's a very good sign. So the price will go up, right? So we'll get the price appreciation as an investor, at least from the short term perspective. So that's one. Okay, so and plus this is a dividend deal, right? So and that's that the company is guaranteed, right? As the history, they provide a good dividend, and the dividend is gradually increasing as well. So that's another good sign. Okay, so we have two good sign so far. But this one I like to tell it to you that I don't like it from the finance activity. What the company is doing, they're issuing the debt, and then also they're paying a lot of debt and interest. Look at the 24 billion and 23. These are in million, right? 23 million of debt it's issued. Maybe the short-term basis they pay, and then they issue a lot, and the purchase of the stocks, right? It goes from there. So company is doing issuing a debt. So maybe what it seems like, based on what I have seen the structure, because they have a lot of equity, so they are issuing now more debt and buying back their equity as well. So playing like that kind of a game. So but this one I really don't like it. Okay, so the another thing is on the enterprise value side, right? So on the enterprise value side, this is on the enterprise value over EBITDA and enterprise value over sale. So usually this matrix I won't cover, or usually I cover this, or won't. Usually I haven't shown much in my past video. I don't think I recall if I have shown that. But I thought from this is a very long, a large cap company has a history, so why not cover from the all aspect? So usually this ratio is used if somebody wants to go and buy the whole company, right? This makes sense. But from that side, even if you see the operating income is way below the total enterprise value. So this means if something is $100 and the company is only generating $2, let's say the $1, or let's say the $2, it will take 50 years for the investor to recover its money. So right, so from that perspective, think that way. So if you invest as an investor, that's just to buy the whole company from that angle, it will take around over 23 or 22 years to recover, so which is huge. And this ratio is getting worse and worse, which makes sense, right? Because if 2012 it's over like 12 or 13, but now it's 20 to 10 times worse, rather than with the time it should be better. And even if I compare with from the revenue perspective, it's getting even worse. So maybe the company is more maybe I'll is not good, looks good from this perspective. Okay, so that's the one thing I like to add. Okay, now let me try to form the opinion. From the opinion perspective, okay, from the revenue diversifications, although they have a different brand, right, which we have seen, but still the major chunk is allocated to the soda drink, which is, and honestly for my kids, they're young, and I don't let them drink those soda drink, and because it's a lot of sugar and they don't drink as well, and from my consumption I'll go for healthy, and I think the trend is from that direction, and I haven't seen any other brand which is so appealing to me that in there, maybe at least for me, but maybe from your side is different, but at least you can agree to me that the major chunk of the revenue, 50%, is still quite high. If it's 20 or 30% from that and more other, I'll see good. From that perspective, I'll give still the -1 mark negative for that. Okay, from the price perspective, okay, so this is my average price, what I got from the intrinsic value perspective. Usually I never share that, but I thought I'll share this time. So I tried the dividend discount model, the free cash flow model, and both pretty much give the same pricing to me. The free cash flow model, I took it was growing for me like a 0.5%, but I took the 0% growth just to be a little bit conservative, but not very conservative. So if I see the share price is right now 45, right, $46, and this is 52, so 52.45 is around $7, so $7 difference. So even if I take on conservative side, right, 52.8, like 20%, sorry, 52 times 0.8, right, so 41, so it will be 41 or 42%. So seems like from that perspective is a little bit from the margin of safety is okay, right? If you want to take 20% discount, which is a huge, but if you ignore that piece, then right, each investor is different, then this means this is the good stock to go, especially, right, because the price, we know it will go around 60, and or at least if you won't go to 60, even if it reaches the $7-8 more, it still have a room to go, right? Okay, on the stock volatility side, I'll give another green signal to it. So from here I'm neutral, and here I'll give a green. So because it's not a volatile stock, it's pretty decent in terms, so that's pretty good. From the liquidity is average, as we have seen, and from the cash flow perspective is nothing amazing, at least from the future cash flow, which I think yeah, it can be done better, but the company is doing some engineering and diversification and all. So so that's what from my perspective. So okay, so this is a global brand. So if I want to make the overall opinion, at least from my portfolio perspective, it's okay, but it's not stand out that great yet. But if you want the decent return, at least, which we can see, they will do the buyback, and from the consistent dividend, from that perspective, on the consistency side, we can keep it, right, as a safety kind of a stock. But if we want a little bit more, then I'm a little bit reluctant. I also want to see how Pepsi will be there, because it's a Coke and Pepsi is a close competitor. But let me know what you think about it, and if you give more likes to this video, and I'll try to cover. If you think it's not, then maybe I won't share that video, but I just do my own analysis. Okay, so that's pretty much on my side. If you like this video, give a thumbs up. Sorry, the videos got a little bit lengthy, but if this is the whole investment from the long-term perspective, right? So we not buying something which we can this, I think, from the long-term perspective, and we are not a trader, right? So we just flip it. So need to spend time, analyze, and so So I take this way, either to spend time now or just buy something and look everyday price-ins and get worried, right? Because I totally agree with the Warren Buffett on, at least on value perspective. You buy the house, you won't go if the neighbor price goes down, or there is some, you won't go and switch the house another day, right? You live in the house because you have the value. So same thing, we are thinking from the perspective of the business and all. So okay, so enough on the talking. So I just want to cut the video, and thank you for your time to stay. Please like and subscribe to the channel if you're new, and if you want me to cover any of your other favorite stock, put in the comment and I'll take a look into it. Thanks and bye for now.